That's right. So we are expecting margins 65% by some estimates. So one of the reasons Apple is rebranding itself as a services company is because of those big margins in the services business. It's easier to make revenue on something like a cloud subscription than it is on a phone. But there's a lot of competition in this space. You know, when we talk about subscriptions, everything from Netflix to Amazon is then a competitor for Apple. So there could be a little bit too much hype in that expectation for that number too.
I wonder if there's just too much in the way of unknowns now for investors, because if you think about sort of the reporting on where the upside could come from, some of it's down to capital returns because there's been a big share buyback program, which means that if it pays out more, then the dividends are going to be high. So that's certainly good news. But the unknowns seem to be around streaming, for instance, what that does for the company, how it's going to penetrate on healthcare. And all that relates to the Internet of Things. And we know that 5G is not truly active yet. We don't know how you're going to connect up a lot of the apps with a much faster technology. So it feels like 2019 might just be a transition year with too many unknowns for investors to help out the share price.
A lot of unknowns, and especially with Apple. I think Apple at its core still is a hardware company. We've talked a lot about how unit sales still make up about half of its revenue. So even as it's trying to undergo this transition, it's certainly not going to happen overnight. It's relying on those higher selling prices for its iPhones. And this is the first time that the iPhone XR, which is that mid-priced new phone, will be included in its numbers. That is going to weigh on its outlook overall because we've had some reports that those are going to disappoint. So you can't completely overlook the core of Apple's business here as it tries to make that transition into services.
I can't help but think, given the focus around earnings in China yesterday with Nvidia, a little bit with Caterpillar as well, that the focus will really be on what exactly is happening in China. I know Tim Cook has already flagged the slowdown there, speaking to CNBC about what he sees in the Chinese market. But there are some questions here over how much of this can be tied to trade tensions, the domestic slowdown in China, and how much of this is a product issue, a competitive issue, if you look at the likes of the competition in China putting out what some would say are better, perhaps more exciting products?
Yep, that's been the big debate about Apple. Is it an Apple problem or is it a macro China problem? And Tim Cook certainly tried to, in that letter, blame a lot of it on China, tried to blame the weakness in the consumer, tried to blame the dollar, you know, some of those headwinds that we're seeing. But that has been supported by suppliers that have said we're also seeing weakness in China. Have to see how much that comes up today.
It's not going to be able to just suddenly tackle the price side though in China, right? Because I saw some prices about $150 cheaper for some phones in some different areas. But one view is that maybe they can bolster the price they pay for customers when they hand over their phone, they're going to upgrade. Perhaps that's the way to tackle it. But that's not very clear for investors about the implications on margins and overall sales numbers in China.
And Tim Cook's really trying to sell this trade-in program that they're giving, which essentially lets you buy a price for cheaper if you're trading your old one. But that's something that has not been a focus of the company before, so that's not built into a lot of these forecasts that we're seeing.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.